Welcome to All Things Moore County, Moore County's weekly radio show highlighting the many facets of the Sandhills. That includes real estate, lifestyle, community and neighborhoods. And now from Fore Properties, here's your host, Bill Sahadi.
Good morning. Welcome to the talk show, All Things Moore County. Dorothy, we're between Mother's Day and Father's Day.
Yes, we are.
Right? That show last week was pretty cute, the moms and their kids.
Oh, yes, it's lively as usual.
So between Mother's Day and Father's Day, we don't do a Father's Day show.
Why not?
Mothers are more important. I don't know. But I always remembered growing up as a kid, I would come home with my report card, and I would have a preponderance of C's.
That I bet you tried to change, didn't you?
No, I tried to throw the report cards in the gutter in Brooklyn as I got home and said I lost them.
Oh, okay.
My father used to always say to me, I'm so sick and tired of seeing all your C's. He said, as you grow up, he said, there are only two C's that matter in your life.
Okay.
He said, one is character and the other is credit.
Oh, that makes sense.
And the two of them are actually kind of intertwined. But today we're not going to talk about character. We're going to talk about credit.
Okay.
And every time my dad would give me advice, I would roll my eyes.
I bet.
And he's been gone now for 20 years, more than that actually. But he was a pretty smart guy. So you have your character and you have your credit. And how do you get your credit? And that's really what we're going to talk about.
Okay.
So are you going to listen?
I am going to listen. Enlighten me.
Well, a past guest is with us today, Laura Glaspie from Southern Trust. She's a lender that we at Fore Properties have had the privilege of working with over the years. Tracy Gibson, who is a broker in our office, who was just on a recent show with us, is back to join us. And Laura, you contacted us and you put together a couple of weeks ago a continuing education class as one of the features of what Southern Trust can offer, because you work with the real estate brokers and you provide us with tools to help provide our clients or to prepare them better to apply for a loan, to understand the process. And you have become sort of like a left arm of our firm with our brokers because they rely on you, they trust your judgment. Tell us about the class that you had in Moore County.
The class that we had today specifically was to educate our brokers,
right,
people that we work with on a regular basis, support you back on credit essentials.
Right.
Things that you need to know as real estate brokers and agents out there, and how to at least guide your clients to us to make sure you're recommending someone who has the expertise at hand to help them with their credit situations.
Yeah. Tracy, good morning. And this is 2 out of 3 weeks you've been with us. That's a record.
Yes, lucky you.
Lucky me. That's right. See, Dorothy, she's smart.
Yes, she is.
We always say that good real estate brokers are like people that conduct traffic. We have to know where to send our clients for different things. We can't possibly know everything, but we have to be connected with good referrals.
Sure.
Right.
Sure. And Southern Trust and Laura's definitely been that for us. We know that every time we have a client, we put them in their hands, that they're going to be well taken care of and represented well.
Yeah. Mike McNamara, who taught the class as the vice president, credit mortgage officer at Southern Trust. And, I've been in this business for 20 years, and I learned so many more things than I had. I mean, it was eye-opening. People think they know about credit scores and they know about Credit Karma, and they go online and they watch the cute TV commercials, but it's so much more than that. Tracy's just going to give me a minute of silence here and say.
No, it is. It was very eye-opening. A couple of us after the class were talking about it was our favorite class that we've done to date, because it is it's not only for our clients, but I mean it's for yourself too. It's reminders and things that you should always be on top of that you just don't think about and you let go, but they're very important.
Yeah. Laura, you get to be the person speaking with our client all the time, and you have to pull credit scores as a preliminary, to do a pre-qualification letter. But some of the buyers have preconceived notions about their credit scores and what it means, and you have to kind of fight those battles all the time.
Oh yes, all the time. And people are very confused because sometimes they actually think they have poor credit when their credit is fine. That's actually more common than the reverse of people thinking they have great credit when it's not, although they both happen. But it's great to help them. And it's also great to help them when they do have good credit to get a higher score. That will help them with their rates and their MI amounts.
We always tell people, if you're going to be out looking for a house, the most important thing to do before you start looking is to affiliate with a lender, get pre-qualified, know what price range you want to be in. Otherwise, it's just window shopping. And sometimes people can be disappointed or let down until they get a full understanding of what they're approved for. Mike, you've been in the business for many, many years, but not always with Southern Trust. But you bring a wealth of experience to the table, and against the backdrop of so many of these credit counseling companies that have advertised over the years about how they can help people, you have a different type of insight.
Yeah, that's right, Bill. Thanks again for having me today. And it was a pleasure to teach the class today. I think it was not only eye-opening for the agents that were in attendance, but also for me just to see the feedback and good positive feedback. And I appreciate you having us there today to teach that class. Yeah, what I like to say, having worked for a credit reporting agency for 30 years before coming to Southern Trust, it's given me the background to help buyers, not with credit repair, but actually with credit rescoring. So there's a big difference where we can tweak something or maybe find a mistake or find something that's missing on their report or get their balances to a proper utilization ratio so that their score will be impacted positively. And what's awesome about that is that we're able to do it in a 72-hour period. So we can quickly get buyers qualified, get their scores up quickly.
So when I hear you say you can do it within a 72-hour period, the skeptic in me comes out, because I think some people will go, well, that's a hook. They just want to maybe promise more than they can deliver, but the evidence speaks otherwise.
Absolutely. As you saw today in the class,
right.
I provided some real life examples of files that were just rescored
right.
within the last couple months,
right.
and the dramatic impact that we can have on getting the scores up. So, in fact, the reports were dated, so you could actually see it was a 3-day time period
right.
between one score to the next score. So, again, as Laura pointed out, it's going to help with their interest rate. It's going to help with their mortgage insurance amount that they have to pay. So it's not just getting, the very low scores up, but even the high scores up, as she alluded to, because we can impact other ways of their loan.
Yeah.
And at Southern Trust, what's nice, and instead of doing the pre-approval letter, we actually approve the borrower. We can approve a borrower in 24 hours.
Right.
Give them an underwriting decision if we get all the documents from them up front. So that has a lot more power when it comes to, looking for a home. If you have a piece of paper that says you're not pre-qualified, you're pre-approved
right.
Through underwriting, which is a big, big positive.
What do you say to the person, Laura, I'll ask you this question. They go on their phone, they've just watched the commercial, they go to Credit Karma, and they come in and go, you don't have to pull my credit. I know what my score is. It's 724. I just pulled it last night. Is that correct? Is that good information?
Absolutely not. The credit scores that they receive, the way I explain it to clients, is that's just a general score that they're looking at from one of those representing companies to give them an idea of where their general score is.
Right.
When we pull the credit score, it's specific for a mortgage loan, because each type of loan has a different type of credit score that is assigned based on their risk for that particular loan type.
People have a lot of preconceived notions. You have to tell people when they're about ready to close on a home not to open up a line of credit, not to go purchase a boat, not to do anything that would jeopardize their standing from the time of their application. But I heard one buyer came in and he bragged to you and he said, "Hey, I'm in great shape. I pay all my bills on time. Oh, and I just closed out 2 accounts that I had, and so I'm clean as a whistle." And Mike, people think that if they close an account, that it's a benefit, but you say no, it's not.
That's right. And not in every case, but in cases where you have a seasoned account that's been open a long time, closing that account can sometimes have a negative effect.
And explain why.
Well, the scores like to see those seasoned accounts as opposed to new accounts. So if you have limited amount of credit to begin with, and then you close out an account you've had for, let's say, 10, 12 years, that account's gone, that seasoning's gone, and it could definitely negatively impact your score at that point.
So you could make an argument that paying down debt could hurt your credit score?
Not necessarily paying down debt, but closing out a seasoned account. So you could pay it down, but not necessarily close it.
Okay. You talk a little bit about soft pull versus hard pull on credit, and I think the Credit Karma we were talking about is that a soft pull? Is that?
Yes.
Okay. So what is the difference between a soft and a hard pull?
Sure. So a soft pull, some examples of a soft pull would be an existing creditor, a credit card perhaps, can go in and look at your credit report. It doesn't impact your score. You, the owner of that credit report, only see the soft pull. Where a hard pull, it means you're applying for new debt, new credit. So that could have an impact. The soft pull has no impact on your credit score at all. Another example of a soft pull would be lenders have to pull a credit report just prior to closing.
Right.
To make sure that no new debt has occurred since loan application, no new inquiries and things like that. That too is a soft pull.
Yeah. Tracy, with a lot of your buyer clients and a lot of the first-time buyers that you work with, and sometimes we have couples that are divorced, separated, or people that have had medical issues. It's very important for them to have their credit reviewed because there could be some things on the report that they might not even be aware of.
Oh, absolutely. I think that happens a lot with our customers and clients. They don't know what's even on there. So it's more of an education process for them, as opposed to just trying to get help and increase it. But I've come to the table with a couple questions from some of my clients.
We like it.
One that we're often asked is, if I have poor credit, can I have a cosigner on my mortgage to qualify?
It's a great question.
So would one of you guys like to
Yeah,
tackle
I'll
that?
answer that. Yes.
Okay.
And that's a sticky question. So to be able to qualify, a borrower has to have the minimum credit requirements regardless. Having a cosigner helps with income, helps with debt to income ratio, but doesn't fix or doesn't outweigh the credit issues of someone. However, with that said, if there's someone that's on the border of qualifying, but they meet the minimum requirements, a stronger cosigner can bring up the strength of the file and make a shaky file more solid and more likely to be approved. But we can't actually use a cosigner to fix an unqualified buyer.
One of the things we didn't cover in the class were the credit requirements for different types of loans. Conventional, USDA, FHA, VA. Are the requirements different from one genre to another?
Yes.
Okay. Can you talk a
Yes.
little bit about that?
There's differences in score requirements, minimum score requirements. There's differences in types of derogatory accounts, amongst others, and debt to income ratio requirements. That's the one that and the credit score is usually the ones. And that can vary from lender to lender as far as the credit score differences. But typically you'll see in the market that 620 is the minimum credit score for an FHA loan, for example.
Okay.
We can go down to 600.
Okay.
That's not as typical.
Okay.
But you'll see if they have a 640 or higher, they'll get a better interest rate and better qualification review by the underwriter. So we still try to get them up even if they are meeting the minimum requirements. USDA is at 640.
Okay.
Conventional, we can sometimes go down to 620, but it just depends on what derogatory items are showing on the credit report.
Okay.
And VA is also 600.
And
so those are the most common.
And the higher your score, the lower your interest rate?
Yes, it directly impacts your interest rate.
Right across the board on
Yes.
all different
Yes.
4 loan types?
Yes.
Okay. There's a lot to this. We want to come back in the second set. We're talking about credit, and we'll leave character aside for another day. But we're speaking with Laura Glaspie from Southern Trust and Michael McNamara from Southern Trust and Tracy Broker, real estate broker at Fore Properties. We'll be right back. Welcome back to All Things Moore County, speaking all about credit, home buyers, the lending process. Mike McNamara is our featured guest. And Mike, there's a lot of talk about going online and getting your credit score for free. And you talk a lot about the 3 large credit companies that everyone seems to know about. Can you talk a little bit about how all those work? Because they all produce different scores and sometimes collect different data for which they base those scores on.
Sure thing. So you're referring to Equifax, Experian, and TransUnion.
Right.
And I do encourage everyone to visit annualcreditreport.com. Everyone's entitled to a free copy of each of the 3 bureaus once a year. However, if you do get a copy of, let's say, Experian, and you dispute something, and you find it's found in your favor, that doesn't count as your 1 free per year, which is nice. It's something new that got established in 2017. Also, each repository can sometimes have different creditors report to them. For instance, I found recently there was a credit union locally in North Carolina that only reported to Equifax. And this particular potential buyer only had accounts with this credit union, so therefore only had 1 credit score.
Right.
So they're not required to report to all 3. We find sometimes collection agencies will only report to one of them.
Mm-hmm.
But in general, the majority of credit items are reported to all 3. But we do see from time to time 1 or 2 only be on one of them, which can explain the differences in the scores. I've actually had a case recently where one of the scores was in the 500s, one was in the 600s, and one was in the 700s.
Same person?
Same person. When we pulled their credit report, we had a 500, a 600, and a 700.
So you had to go with the 6?
Exactly. So that's a point we could talk about too. Every lender has to throw away whatever the highest one is, whatever the lowest one is, and qualify based on whatever that middle score is. So in this case, there were things obviously that were on the 5 and 6 that weren't on the 7, and they were negative items, which were bringing those scores down. So that's you can see that from time to time. But I will say in general, they're usually around in the same ballpark, the 3 scores.
So Laura, if you're working with a buyer and they're qualifying and you see their 3 scores, and let's say there's 600, 620, and 640, you have to work with the 620.
That's correct.
But then you say, hey, we need to speak to Mike. Tell me about that process. How does all that work to try to get their scores up?
Normally when I pull the credit report, if I see that, I immediately send the credit report straight to Mike and ask for his advice in the few minutes before I even call them back. Sometimes he's able to respond that quickly, and if so, I just make it seamless and give them my direct recommendations, and I cite our credit expert that's in-house. And
sometimes she doesn't cite me, though. She takes full credit.
She takes full
I know she does.
And,
Tracy, what do you think? Do you think she
Smart
does
lady.
that?
Well, I take full credit that you're here, for sure.
I'm kidding.
But yeah, that's how I normally do it, because it just makes them less fearful of the process if we keep every little interaction streamlined, and that helps.
Do most lenders have this type of a setup or situation where
No.
I'll answer that too.
No.
I feel like no.
Yeah, me too.
It's just so easy to work with them because you feel like things come the answers come much quicker than with a lot of the lenders.
So what
Thank
do
you.
you?
That's-
So what's it? So that you get there's credit counseling that comes along with the loan application. You go through the process and
Mild credit counseling. We let them know what the recommendations are.
yeah.
And most of the clients will let us know if they're interested. Some aren't. They don't want to work on it.
They don't want to work on it.
They don't.
They don't want to get along better in life. Okay.
No,
Okay.
no. They like their situation just fine.
Okay.
But the ones that really want the help, they are in it. And Mike will even work with them directly all the way until he can hand them back to me to get them qualified.
Yeah, Mike.
It's not really counseling. I would more call it advice, not advice, but the word I'm looking for, but
Guidance.
just suggestions, guidance. They a lot of times ask us the questions.
Right.
So we're not really giving guidance. We're just answering questions that they have a lot of times where, suppose this credit card was paid down to 30% of the limit. Would my score go up? Absolutely. That's where the utilization ratio would be ideal for you. That type of thing. Based on things I've seen in the past, that would be a good thing to do. So it's not like full force credit consumer counseling. It's more just giving pointers and answering their questions on things that, whether or not they should do something. Like you brought up earlier, closing an account. Should I close this? Well, I've seen that drop scores would be my response. I'm not saying don't. I'm not giving you full counseling not to do it. I'm just saying you might not want to consider that. Look at the factors that it may impact. So that type of feedback we give them.
Yeah, most lenders will
Laura.
say your credit score is 620. You need to work on some things, pay off your collections, and call me back in 6 to 12 months so we can take another look. That's what normally
and
happens.
6 to 12 months doesn't cut it if we are working with Tracy with a buyer who's looking for a house and they want to close in 2 to 3 months. So they need some help right away.
Right. And even if it won't happen right away because of the situation, we need to know that that's a real expectation, not just a loan officer saying, this is what I think it'll be. We want more advice than that, more expert advice.
Okay.
And what we have too, Bill, just to add on to that is, and rather than say come back in 6 months, over the years, I'm in the credit business for 30 years now.
Right. You don't look a day over 35. It's crazy.
I'll pay you later.
Genes are good. Good genetics.
Thank you. But I have probably rescored tens of thousands of potential buyers just from working at the credit reporting agency.
Okay.
So I've looked at that many files.
Okay.
I can't see everything that's going to happen. So we have some tools at our disposal, and one is from a company called Credit Expert, and they've developed a simulator, if you will, and it's kind of like if I'm stumped and I don't see how I can get 10 points to get this buyer a better rate or get him qualified, or maybe I can lower her MI by getting 10 points. I can have this tool at my disposal where I can actually bring it up and say, what if this balance was lowered to this? How many points will I get? And it simulates the scores. Now, it's not exact. There's a plus or minus margin of error that I would say is about 8 to 10 points. But if it says I'm going to get 25 points and I only get 20,
right,
I'm ahead of the game, and
right.
I'm not waiting 6 months
right.
and then find out, whoa, I only got 4.
Right.
Based on what I thought would happen. So I have a lot of tools like that at my disposal that I can utilize. But most importantly is the 30 years of experience and looking at files and helping buyers get better rates and get qualified.
So in your 30 years today, knowing what you know, what do you tell a first-time buyer who want to buy a house? What are the things that come up most commonly that keep their scores low that they can do something about today before finding a home to purchase?
Well, a lot of times we'll see some derogatory items, some late payments. So you obviously want to avoid that at all costs. If they have credit cards, avoid being 30 days late because you're not late till you're 30 days late. You may have a late fee prior to 30 days, but you're not late till you're 30 days late. Avoid that at all costs. Keep an eye on your report for medical collections, things like that pop up without your knowledge. You know, it could be dental, it could be any type of medical facility. And a lot of times we find over the years that buyers don't even know that they're on their report until we pull it. So there was a medical insurance issue. It shouldn't have been there to begin with. Keep an eye out. The most important thing I think for someone just getting into the home buying process would be to get a free copy of your report up front before you even get to the realtor.
Right.
Go to annual credit report, get a free copy of your report, look and see if there's anything going on there.
And you said don't pull all three at the same time, stagger them every 4 months so you can get a more updated version throughout the 12-month period?
Well, so that you can get it more than once a year.
More than
so
once
if
a
you
year.
go to annual credit report and let's say you get Equifax, I would wait 4 months and then go back and get TransUnion, then wait and get then you can check more than once a year.
Okay.
And in general, like I said, the majority of accounts are on all three. There may be slight differences between the three.
Okay, so you're like a financial credit MRI machine. So you look at the report and you see 2 or 3 credit card balances, and then you look at the maximum credit limit, and you're looking for the relationship between what the limit is and what they owe. Can you talk about that?
Yeah, so that's the utilization ratio.
Okay.
So if let's say, for instance, you have a credit card that's $1,000 limit. Your balance is $900.
Mm-hmm.
That's holding your score down because your utilization ratio, you're almost maxed out. Ideally, if we can get that balance to 30% of the limit,
$300. Okay.
we're going to get a nice increase in the score. And sometimes it's already there, but it hasn't been updated yet.
Within 72 hours.
Within 72 hours. So they pay that account down. I get proof. I submit that proof to the repositories, and then we have a new score 3 days later. In most cases, 3 days later.
So, Laura, working with these clients, there's no extra fee to them to have this counseling done.
That's right. We do not pass that cost on to the client.
What about these companies that are out there today that says, heal your credit, cure your credit, call us at 1-800-CREDIT is us or whatever. You're not a big fan of those firms.
No, as I mentioned earlier today.
Mention it again.
Not a fan of credit repair. A lot of times they're just disputing everything that's on your report in hopes that, the bureaus can't prove it in the time period that's allowed by law, and they have to remove it.
Right.
We don't get involved in any of that. Disputes are actually bad on a mortgage credit report. We have to get rid of them. So we actually do rescoring, not repairing.
Rescoring.
Exactly.
Okay. We're going to come back in the third set, talking with Laura Glaspie from Southern Trust Mortgage and Mike McNamara. Tracy Gibson, we're getting you involved in the third set.
Yes.
I have a couple of questions. I know you have a couple of questions you want to ask. This is All Things Moore County. We'll be right back. Welcome back to our final set of All Things Moore County. I've been in the real estate business for 20 years, and the loan process is such an integral part of being the matchmakers that we are, matching peoples with homes and making sure that they take all the right steps. And the conversation we're having about credit is just an extension of making sure that that first step towards getting pre-qualified. We do everything we can to help our clients maximize their interest rate, not necessarily their loan amount, because people can be pre-qualified for a lot more than what they need. And that does, if somebody is qualified for $400,000, that doesn't mean they should be looking at a home at that price. A lot of people will say, well, I want to be disciplined and go lower, which is fine. But making sure that the credit is firing on all cylinders keeps that interest rate so low or much lower.
Yes.
Right?
Yes.
So when you take an application, you have your antennas up all the time, right? You're
Always.
always looking for red flags. Taking an application is the most important part of the loan process.
A complete application at the very beginning.
Right,
Yes.
because if you miss something, it comes back to bite you and comes back to
Bites
slow the
everyone.
process.
Yes, it's very bad.
Right.
We want to unveil everything at the very beginning.
Yeah. So you've had a lot of experience in this business, in many different ways. Paralegal, as a lender.
25 years. Yes.
And so you see the whole playing field. Mm-hmm. And your partner here in crime, Mike, I know he sees the whole playing field because I got to listen to him for 4 hours.
Yes.
And I bought into everything he
Did
said.
you just say I play the field?
Yeah. I don't know.
Wait a minute.
So, and he was a comedian before in his earlier life, I think. Tracy, couple of questions for Mike. We unfortunately we don't have as much time as I'd like, but I know there are a couple that you want to ask him.
Well, one thing that we often talk about with our clients are when they come in, we want to push them to use a local lender. It's just easier, and they make things happen, especially when it comes down to it at the end. And a lot of them want to search different mortgage lenders, mm-hmm. and they often ask if their credit is being hurt by searching, multiple lenders. And what would you say to that?
I would say that there's something called rate shopping. Mm-hmm. So if you shop for a car, for instance, or you shop for a mortgage, something within the same industry, within a 30-day window for Equifax and TransUnion and a 15-day window with Experian, all those inquiries will show, but it only counts as one hit against your score for that time period. So they could go to 3. I mean, we prefer not to have all those inquiries on the credit report because any inquiry on there we have to address as a lender to make sure there's no new accounts and things like that. So it's probably better just to have the one inquiry. But if they did shop and they went to multiple mortgage companies, the inquiries would all show, but as far as the impact on the score, it would just count as one hit for that 30-day window or the 15-day window with Experian.
That's good to know.
That's huge, and it just gives them a little more freedom to kind of do some homework on their end, I feel like.
But they do need to keep to the 15-day window because we pull all 3 credit reports.
Okay.
So that one is going to impact the rest.
Got it. And then another thing that we often hear is if they don't have any credit history, what's their plan, and how long does it take to kind of get to where they need to be and establish some history? Do you have a plan that you kind of...
Sure.
I
told the story today. Yeah, that's right. I told the story today, getting my daughter started or getting your kids started with credit, shortly before they get out of college so that they have a foundation. Sometimes sometimes they have a student loan. We've heard some people have a few student loans nowadays,
right.
Which is the start. But you need some other types of credit, a revolving account. The scores want you to have the variety of trade, installment, revolving. So if they have nothing, I always say start with the institution that has your checking and savings, because they're the first to give you a low-limit Visa or MasterCard. You could also get added as an authorized user to a parent's account. However, we can't live alone on an authorized user. We have to have some other trade that's just in their name. If all we have is authorized users, that's not a good report. Mm-hmm. We can't fly with that. Mm-hmm. So you need to, but that's a good way to start, to get something on your report, and then you can build from that. So there's lots of ways to do that. And in general, if you don't get added as an authorized user and you're just opening new accounts, it's going to take 3 to 6 months mm-hmm. to really establish a good credit score and have some seasoning going on before you get a good score. But an authorized user in combination with that would speed that process up.
Yeah. You talked a little bit about the difference between a department store card and a credit card, an Amex, a Visa, a MasterCard. Mm-hmm. The credit agencies don't look at the department stores the same way they do a regular credit card?
I wouldn't single out just department stores, but I think they they like the major credit cards.
Okay.
They like lower interest credit cards.
Okay.
So credit cards that, have the 12 and 13% are much better than the 18 and 21 and 24% that you sometimes see with the other types of accounts. So ideally, if you have the major credit cards, that's all you really need.
Right.
You really wouldn't need all the others to go with it.
And if you got a major credit card, but you pay off your debt monthly, so you always have a zero balance, is that okay?
That's a great thing.
Okay.
You should definitely want to, if you can, at all possible, pay off your credit card to not accrue interest, not carry high balances. If you have to and you don't have the means to pay it off every month, we want to get at least down to that 30% of the limit ratio for the best possible score outcome.
One of the things you spoke about also was in trying to correct or update some of the balances and this and that. You talked about a removal letter. Can you refresh me on that?
Sure.
And
So a
why
lot of
it's
times,
important?
and many times this occurs with medical collections, where they're on the report and maybe it was a medical insurance issue, maybe there was a mix-up in the billing, maybe they didn't get to the right address. Because we do find quite frequently that a lot of buyers aren't even aware that there's a collection on their report. It might be a $50 medical collection.
Mm-hmm.
So I encourage them to try to negotiate to pay it, but try to get them to give you a removal letter as well, because it really shouldn't have been there to begin with. So let's get it off of there,
Right.
as opposed to just showing it paid, because that would have a much bigger impact on the score by making it go away as opposed to just showing it as paid.
So when that shows up on the report, Laura, you're dealing with the client and you're sharing that report with them, and they're saying to you, "What? This isn't mine," or I don't know where that came from. You're dealing with it firsthand before Mike ever gets a hold of it.
Yes.
So you're just prepared for. People are surprised what's on their report.
Oh yeah. Oftentimes they're surprised by what's on the
Almost
on the
everybody,
report.
right?
Mhm.
Yeah, I could also give you a live example where, my sister, one of my 4 lovely sisters,
Right.
called me and said, I'm
Little
trying to
latitude. Never heard.
I'm trying to get a home equity line, and I was denied. I'm like, well, what are you doing? And there was a medical collection she had no idea about,
Right.
a very high number,
Right.
that because the institution didn't have her proper insurance, a department at the hospital, a collection was filed. She never got anything in the mail. She was never notified. Well, obviously it was taken care of by insurance. So once we got that removed, she got her home equity line, as opposed to just paying it because she wasn't responsible to pay it. So we see it happen quite frequently where things show up. It's getting better, I can say, but it's still quite prevalent. We're seeing collections that probably shouldn't be there because of insurance, and then in turn we're getting them removed.
Right. Laura, what percentage of loans that you do result in conversations that you have with Mike where you're trying to increase the credit score of the borrower?
I would guesstimate around 15-20%.
15 or 20? Now, I thought it would have been higher.
Not here in Moore County.
Oh,
Yeah. In Moore County, we have very good credit scores overall, believe it or not.
okay.
Yeah.
So not in Moore County, but that means in other counties.
And other counties surrounding here has a higher incidence, yes.
So 20% of her loans a month, that's like 500 loans I'm working on for her a month.
Isn't he a funny guy? The comedy comes for free. I mean, honestly, we thought we were
wonder
just
I'm
going to
so
talk about
busy.
credit. I started out talking about character and credit, and you have how many children?
Well, I think you're quite a character. Not that type of character. I'm sorry, Bill. Jeez.
I think you met your match, Bill.
I think I have. What did
I have? How many kids do I have?
Yeah.
I have a daughter who has 3 beautiful. Has given me and my
Grandsons.
wife 3 beautiful grandsons,
Right.
and twin boys that are 27. And then
Wow.
I have 4 sisters and 2 brothers, so I come from a big family.
What advice do you give to people when they're starting out to get on the right credit road and stay on the high ground, and because you really want to pay attention to it? It's like practice. You have to.
Yeah, there's probably 4 words I would use.
Okay.
Live within your means. because we see nowadays quite a lot of people with, overloaded credit cards,
Right.
Overextended. They're spending more than they make.
Right.
To be responsible that way, and pay your bills on time.
Right.
Because one little ding, one little 30-day late could be 30, 40 points on your credit score, which could mean the difference of a good interest rate and a not so good interest rate. More of a house or maybe less of a house. So, pay attention to those two things, I would say.
Laura, do you have any experience with people who come in to borrow who are recently divorced?
Yes.
In the process of separation.
Yes.
And they bring another host of possible problems to the table.
Yes. It's infinite. The most common situation is we have to wait until they have their property settlement finished.
Okay.
So we know who is responsible for which debts.
Right.
And who is receiving what assets, and whether or not they owe each other any money, child support, alimony, and maybe reimbursing each other for assets. So that has to be settled. But what happens sometimes is the spouses haven't spoken with each other during the marriage, and there might be debts that one or the other didn't know about.
I always hear about people saying, my spouse ruined my credit, or there were bills that I was never aware of, and now I'm dealing with it. That's not an uncommon thing.
No, and that would be answered by taking Mike's advice on having your own credit report looked at. I do mine quarterly as well. I do it every 4 months, I should say, not quarterly. And I make sure that nothing is on there, because you just don't know. And that's the best method of prevention in those situations.
So the site, Mike, that you recommend is annualcreditreport.com.
That's correct.
And you have to give a lot of your own personal information.
Absolutely. So you do want to make sure, my portion of the class today that started with fraud, I covered fraud quite a bit today. Be aware of any website you go to that it's HTTPS. And annual credit report is HTTPS, which means it's a secure website.
Right.
So entering that personal data to get your credit report, you should feel safe doing that. If it didn't have the S, I wouldn't recommend any website that doesn't have that HTTPS.
Okay. Laura.
And something else that I recommend to clients, some of them are honest at the beginning and say that they have credit issues. I recommend that they pull their credit report there and provide me with the report.
Right.
So Mike and I can review before we do a hard hit on the credit. So we will do that too.
Okay. A good sense. You know what? It's been a few years since I've done mine. I'm going to do it again. It's free. And it's sort of like having your house appraised. You just want to see where the value is today, and it's like catching a bird in flight, because it changes on a daily basis or a monthly basis.
Still $850?
If I added up my two scores from the last two times I pulled, I'm over $850. I'm just under $900. Mike, it was a pleasure to meet you. On behalf of the brokers at Fore Properties, we really enjoyed having you come in, and Laura, we thank you for putting it together. It was
my pleasure and my honor.
CE class. I hope we can do it again.
Absolutely. Thanks for having us.
Yes.
Thank you.
Laura Glaspie, Southern Trust, thank you. We hope to see you again. Tracy Gibson, you're going to become a regular here. I talked to her and my phone drops. What can I say? I don't know. It's a busy season for us, and there's so much stuff going on, but you're at a point where you've really gotten to get the full gist of what it means to be fully employed in the real estate business, and you're doing a great job.
Thank you.
Anyone that gets to work with you is lucky.
Thank you, Bill.
This is All Things Moore County. We'll see you next week. Thank you.